Okay, welcome back. We're going to be talking about fixed assets today. Actually, we're going to be talking about fixed assets as well as intangible assets. Fixed assets are those assets that are going to be long-term in their lives, and they're also tangible. Tangible means you can actually touch them, physically put your hand on them. So it could be anything from a desk to a chair to a car or to a building. Any of these things are considered fixed assets. Intangible assets, which we'll talk about a little bit later in the chapter, those are items that you can't put your hands on. They're still assets to you, but you can't physically put your hands on them because they're intangible. Now, before we continue along, fixed assets are long-term assets, and they show up on your balance sheet after your current or short-term assets. And normally they fall into the fixed asset category. If you're buying something that's going to last you longer than a year and you can touch it. There's one little piece of that's slightly different. There's one different way to look at it. And we use this little flow chart for it. What you can ask yourself is the purchased item, what you've bought, long-lived? Is it going to be around for more than a year? If it's not, then it's an expense. So you want to think about highlighters, I don't know, I always just say paper clips, those kinds of things, supplies, expense. Those things will be around only for a little while, any sort of maintenance supplies, anything like that. Those things are traditionally going to be used up within a year. But if we're going to be using the asset for longer than a year, then it qualifies normally as a fixed asset. All right? And this is where our land, our buildings, etc. go. There's only one exception to this. And the exception is if you don't plan on using the asset you've purchased in your business, basically as a productive, as part of your production, as part of your regular business. For example, then it's called an investment. For example, if you were to buy a building that you didn't actually intend on using in your business, but you bought it because it was a good price and you think you can fix it up a little bit and resell it, and you're never actually going to use it in your business, that is not your plan, then you're going to classify that as an investment on your balance sheet and not as a fixed asset. Meaning you're not going to depreciate it or you're not going to depreciate it over time because you're not going to be using it. But we'll get into depreciation in a few minutes. When you acquire a fixed asset, we're going to go through the major categories here. When you acquire a fixed asset, it's not just the cost of the asset that gets included with the price of it that you record on your balance sheet. Let's start with land as our example. If you're looking at a piece of land and say the piece of land is worth $100,000, that is the actual price on the piece of land. Well, that's the purchase price for your piece of land. So there you go, $100,000. But you might have to pay some other things in order to get that land. Perhaps you have to pay sales taxes when you purchase the land, or maybe you need some permits from some government agencies. Maybe you have to pay some broker's fees or some title and surveying fees. We'll get back to delinquent real estate taxes and actually the rest of these in a minute. The idea is that all of these costs are additional costs for you to get the land. So if the land was $100,000, but all of these costs that are in here were another $20,000, the cost of the land was really $120,000, and that's what you should be recording on your balance sheet. Okay? So let me go through some of the odd ones here. Delinquent real estate taxes. Delinquent real estate taxes. Normally when you have real estate taxes, it's, let me put it up here, it's a simple journal entry when you have real estate taxes. Normally it's just debit to property tax expense of some amount and a credit to cash of some amount. Oops, too far. Okay, that's your normal journal entry for property taxes. It's just an expense of the period. It's a necessary expense in order to do business. All right, now there's a key word here, delinquent real estate taxes. If you have delinquent real estate taxes, that means the taxes haven't been paid on this property in a while. Well, before the purchase is allowed to go through, all those real estate taxes need to be paid and caught up to date. So, they're delinquent, they have not been paid. So if you need to pay these old real estate taxes before you can actually purchase the land, then you're also allowed to add those taxes to the cost of the land. All right? Raising or removing unwanted buildings, less any salvage. Okay, so maybe you're buying a piece of land and it's got an old building on it that you don't want. You don't want the building. You plan on knocking down the building and building your own building on that land. Okay? The thing is you want the land the way you want the land. So if you have to remove an old building, that's going to be expensive. You got to have dumpsters and bulldozers and all that kind of good stuff. Then that is going to also get added to the cost of the land. So if it costs you $10,000 to knock down a building, then so be it. That cost also gets added to your land. Now here's a little side note here, less any salvage. Okay, maybe you're knocking down that building for $10,000, but you go into that building and you see that it's filled with copper piping, and I hope if you don't know about copper piping, you can Google it. But it's worth quite a bit of money, and people steal it from buildings all the time. So perhaps you go into this building and you see that it's filled with copper piping, and you decide you're going to rip all the copper piping out and sell it. Maybe you make $3,000 on the sale of all that copper. All right, so the cost of the building, knocking it down, was really $10,000 minus any salvage that you took from it. In this case, the copper of $3,000. So the actual cost of knocking down the building was really $7,000. All right, I hope you got that. Another section would be grading and leveling. Okay, if that land was hilly and you didn't want hills, or if it was flat and you do want hills, whatever the case may be, you want the land the way you want the land. So if that requires grading and leveling, or even digging a giant hole in the land, if that's what you want for the land, then all of those costs get added into the cost of the land. And the last one is paving a public street bordering the land. All right, so all of these items get added into the cost of the land. Now I want to say it right now, and I'll probably say it again later when we talk about depreciation, but land is the only asset that never, the only fixed asset rather, that never ever 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 gets depreciated, not under any circumstances. Okay, land doesn't lose its value over time. Land is the same land that dinosaurs have walked on. It does not lose its value. So land does not get depreciated. It doesn't devalue over time. Let's see. The one other thing I did want to mention is that if you're thinking maybe, well, what if you pulled gold out of the land, or you pulled oil out of the land? Doesn't that have some sort of consequence to the land? Well, that's really something that's called depletion. And we'll talk about that a little bit later in the chapter. But the using up of natural resources is actually, like I said, called depletion. All right, so let's talk about building. Now this could be if you're building your own building, or reconfiguring an existing building and fixing it for your own purposes. Okay, the cost of the building is going to, of course, be all of the materials to build the building itself, but there are also some additional fees that you may not think about, because they're not actually direct costs associated with the building, but they do get all added into the cost of the building. So maybe the building cost you $500,000 to build, right? And then you've got architect's fees you need to pay, and engineering fees, and any sort of insurance costs, any extra insurance that you may have needed during the construction. Or if you borrowed some money to pay for the construction, took out a construction loan, you'd be paying the interest on that. If it's while you're building, then that interest gets added into the cost of the building. Perhaps you have to put some walkways around the building, and permits from government agencies. I'm jumping around a little bit, but those are all the costs really more of building a new building. Now, if you are, if the cost of the building is $500,000, if all of these costs are another $20,000, then the building actually cost you $520,000 to build. Okay, so what you do what's called capitalizing, and I didn't mention that term before, but when you make something an asset, what it's called is you capitalize the expenses. All right, so what you're doing is all of these things that you would think of maybe as expenses are really being capitalized, and what that means is they're being made into an asset. They're being made into the asset of building. They're all getting added together. Okay, now if you were to revamp an existing building, you may have bought a building and you might have to pay sales taxes on that building, or you may have had to repair an existing building. Or reconditioning. What if you had a dentist office that you decided you wanted to change into a hair salon? I mean, the sinks were already there, right? That's called reconditioning, making the building suit your purpose. Any sort of modification for your own use, and as I said before, permits from any government agencies. All of these costs get added together to be the total cost of building. All right. I think I'll stop there, and we'll get back to machinery and equipment in just a second.